The majority of people today have serious problems with their finances. They are running on fumes. They're redlining it, pushing it to the max. When a person gets a raise at work, they buy a new car, move into a new house, take expensive vacations, and generally spend more. They don't have money left over at the end of the day. And that is becoming very clear right now. You came here for the truth, so let me unveil that for you. I've got some interesting statistics to get into. I've got some information that needs to be shared. We're going to look at the economic side. We're going to look at the stock markets. I want to show you what's happening here with the stock, specifically with how far they have gone. It has been excessive. The market actually went back, retraced some of those losses, and has now been moving up. Of course, everything is fine, so buy the dip. I'm going to show you the data you need to know behind that, so let's begin. More than half of households in the four largest U.S. cities struggled financially. This survey provided a clearer picture of the extent of the struggles in the United States' four largest cities. Okay, so you can see at least half of all households in these cities, 53% in New York, 56% LA, 50% Chicago, 63% in Houston, reported facing serious financial problems, including depleted savings, problems paying credit card bills, and affording medical bills. That's the big one. I'll show you the data directly from the source, but I just wanted to look at it really quickly here. We're talking about the biggest cities. You might live in a place and you might be experiencing no different situation than what you were 6 months ago, than what you were a year ago. Everything might be totally fine for the people around you and everybody that you know, but you can see the data, and the data doesn't lie. You can bend it, you can manipulate it, but when you see this type of thing being mirrored all over the place, you start to paint a really good picture. This is just one survey. It's not going to give you all the answers, but when we start to piece it all together, we start to connect the dots, it really makes a lot of sense. And it is unfortunate because so many people today cannot even afford their shelter, the most basic thing. When the food prices are rising considerably and the Federal Reserve tells you that they want to increase inflation, they are struggling to create inflation is what they say. Same situation in Europe and basically all around the world. Japan has a difficulty increasing inflation, but look at the housing prices. People live in little shoe boxes or matchboxes practically. It's not a good sign when they can lie to your face and get away with it, because people, they'll swallow it. Poll. Half of households in the four largest U.S. cities report serious financial problems, including depleted savings, paying bills, medical care as well. This is directly from the source. I thought it was really interesting that you can see it's affecting households with annual incomes below 100,000, as well as households experiencing job loss or wage losses. I thought that was of note because specifically it's $100,000 for a household income. In the big cities, it can be very expensive, but it's not those at the very bottom, really, when you think about it. Even though 100,000 for a household doesn't get you much in a place like New York City, it's middle class, and that's the way that it has been. Life has been more expensive. Things become unaffordable, and while you have housing prices up, and when you have food prices up, and electricity prices are up, and yet wages have been stagnant, or in most cases, when you factor in real terms, it's actually declining. And that gives us an idea that, truthfully, at some point, you have hardship. We're facing that today, we're seeing that now, but who knows where it'll be in a year or two and beyond. The same situation is going on in many major cities, but this one happens to be about New York. Business vacancies rise on New York City's Broadway. The situation of 2020 strains companies along Key Avenue. Survey finds 78% increase in empty storefronts since 2017. Of course, there's too much retail. Of course, there are problems right now. Rents are way too high. Not enough people want to get into this type of business, brick and mortar. That's a challenge for sure, but we have really gone too fast because of everything that's happening in 2020, and as a result, you've got a lot of these serious strains on the mortgage-backed securities, the landlords, the tenants themselves, the business owners, and everyone in between. There were 335 street level vacancies along Broadway. It's not just this one street, of course, but that's what this article is about. I've shown you so many, and it's not just New York City either, but it is a prime example because we were looking at rents being something like $4,000 for the average person residential unit in New York. That is just unaffordable for most people. Doesn't matter how much you're making per month. If it's $4,000 just for your rent, you got to add food on top of that. You have to add your utilities on top of that. And that's just the basics. That's just to live. Of course, your 200 square foot micro apartment isn't exactly the Ritz either, right? People would say, well, you got to bail them out. You have to create a system that bails the people out. Well, check this out. Copycat websites, newly minted companies, double dippers cashed in on PPP loans. So you create a system where people can get some relief, and there are those that take advantage of it every single time. Now, some people get caught. I think I showed one with a Lamborghini or something that a guy bought. They will catch people. There's no doubt about it, but you're always going to have this from top to bottom being a problem. You know that. This right here just shows you some examples. If you want to read the article, it's here for you. From Memorial Day through Labor Day weekend, which comprises what is generally the busiest and most lucrative time for airlines, screenings were down nearly 76% from the same time last year. So I had shown you some information, I think it was in yesterday's video. I didn't have the numbers in front of me. I wanted to pull that up for you. You could see that the traffic has declined 76% year over year. And that's now. Of course, it was much worse a few months ago, but right now, today, we are still way, way down. And it might get better, but really, over the last little while, it's kind of been stagnating. What does that mean? You got to look at the airlines themselves. You have to look at the manufacturer of these airplanes. You have to look at the actual jobs that are directly in the airports. What about all the Uber and the cabs that are coming to pick up these people? What about the manufacturing? What about all the service jobs that are taking place here all around? Different trades, different types of workers. There's so many things that go into this when you stop and think about it. There's vending machines, of course. There's all types of little shops that are there. I mean, I could go on. I could use the alphabet twice over if I need to. It's not just Boeing that's the issue. It's not just the airlines that are the issue. There's a lot more to it. And sure, Boeing might get a bailout. American Airlines might get a bailout. But what about all of these others that are not being spoken for? All right, I want to change the page here. We're looking at what's going on in the stock market. It's been so excessive. Yesterday's video talked about the market plunging. It was destructive in such a short period of time, but as some would say, it was a healthy correction. Take a look at this. The NASDAQ completed a 10% correction just 3 trading days after setting a new all-time high on September 2nd. This sets a new record for the fastest 10% correction in history. Now that's important. That's in percentage terms. We're not talking about numbers. I know if you go back to the old videos where we're looking at stock market comes down by 1,000 points, a whole bunch of people that are really invested heavily, they come into the comment section, oh yeah, well 1,000 points isn't much these days. My 7 shares of Amazon are still doing good and so on. I get it. This right here gives you an idea of how fast things can turn around. That's all it shows. The market has $7 trillion of liquidity behind it. I'm sure there's going to be more up days. The Swiss National Bank is one of the leading tech investors in the world. 28% of the SNB's equity portfolio is allocated to tech stocks. They have 17 million Apple shares that are worth $6.3 billion and 500,000 Tesla shares worth $630 million. There's the breakdown if you're interested, but that's excessive. I understand they've been getting extreme growth throughout this period when they're so heavily invested in tech. Over time, they've been actually increasing that. But what happens on the way down? Do they just print a whole bunch of money to fill in the gaps? It's ridiculous when a central bank can act like a hedge fund fund because the currency that's behind it is supposed to be strong, it's supposed to be stable, and then you have risks being taken. I'm just using this as an example. All of them are doing something similar, whether they're buying bonds or toxic debt, or they're buying the ETFs, or they're buying stocks. They play games, and that's your currency. If you live in Switzerland, if you live in Japan, if you live in the US or Canada or wherever, there's a central bank somewhere that's manipulating the value of your currency. They never once ask your permission. Is it okay if we do this? No, of course not. I would highly recommend checking out this article out of the Financial Times. This US stock bubble could rank among the biggest in history. Just like in late 1980s Japan, wildly exaggerated growth stories have forced up the prices. You know how many there have been. We've seen it all the time, coming in the news, buying up bankrupt stocks, using crazy levels of margin and options being used by amateur investors. All these wild things have been happening. This article covers many of them. It's really in depth, a lot of information, a lot of numbers that are really wild when you look at it. I'm not going to get into it all, but I'm going to put in the link in the description as always. Definitely check it out, really good. Speaking of exaggerated, this is the Wilshire 5000 over the US GDP, also known as the Buffett indicator. When the market came down in 2020, it actually went down to a level that was, let's say, historically more reasonable. Today, however, it has flipped the script, as you can see right here, because in a short period of time, it turned around really, really fast. And you can see how unbelievable to look at these valuations, to look at where we have come and where we're going. It's not good. It's not healthy. There are so many stocks today that technically are undervalued. There's been all this money printed, there's low interest rates, and yet just a handful of stocks are seeing most of that. You know, that's dangerous. And that brings me to this article here, out of Real Investment Advice. He gets into what's happening, the bubble, and so on, and he mentions this particular stock, which is CVS, saying how despite all the attention on Apple and Amazon and so on, you've got a stock like CVS that is extremely undervalued. I am not suggesting anybody buy this stock. I'm simply using it to illustrate a point. At the top, you're seeing the chart, which basically shows you CVS, then the S&P 500 average, and then the top 30% of stocks. The PE ratio is just ridiculous when you look at the S&P 500 average, 26.5. The top 30%, 49.9. The PE ratio for CVS, 7.7. Does it get any attention? No. Over the past 5 years, CVS has grown earnings and revenue at an annualized rate of approximately 12%. That's fantastic. That is 3 times the rate at which the S&P 500 has increased for each. Despite the strong fundamentals, CVS has badly underperformed the S&P 500. This graph over here, the orange line being the S&P 500, as you can see throughout 2020 has done very well, and yet CVS has really lagged. Again, I'm not telling anybody that they should be buying this. There's other issues. There's other numbers that you need to look at, not just PE ratios and a handful of other indicators. But I'm trying to make the point that we enter this stage where it's a narrowing band of available stocks that people are buying. It used to be the NASDAQ. Okay, then it was the FANG stocks. And then that sort of changed a little bit and is less and less and less. And we enter a point at which there's only a couple that people are really buying, at least in comparison to the others, and that is never a good thing historically. We saw that specifically in the tech boom and bust, but it happens every single time. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. So I want to thank you for that. In fact, I want to thank everybody that has supported me in any way that you can. I really do appreciate it. Thank you. If you want to learn how to sell stuff online, you want to understand e-commerce, you don't know where to start, or you don't want to pay any money, well, I got you covered. The AmazonGPS.com. The financial system, it's complex, it's convoluted, it's difficult to break down, but I've done it very, very simply. Everything you need to know to give you that foundation, the knowledge to ask the right questions are in these 2 books. Definitely check it out at the link in the description. If you want the audiobook, themoneygps.com. Wait a second, don't go anywhere. Have you seen this video? Really good stuff. Definitely check it out. I'll see you there.